Hello, everyone. This is Jim Riggio and Bruno. We're going to be going over Bruno's trade today. And I'll give him the ball in just a second. Before we get started, though, a quick disclaimer. Capital Discussions is not a broker-dealer or investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any trade recommendations. The risk of loss trading options can be substantial, so please be aware of all risks prior to placing any trades. Hypothetical computer-simulated trades that we'll discuss during this presentation are believed to be accurate. However, due to such factors as commissions, slippage, and liquidity, your profitability will vary. So, welcome, Bruno. I'm glad that we finally ended up getting a chance for you to be able to end up talking to the general community in and around how you've been doing and your trades. And so, without any further ado, let me make you the presenter.
Thank you, Jim.
You have the ball.
Oh, really?
Hang on here. Okay.
Okay, share my screen.
And it's coming up.
Right.
I see it now.
Right, okay, so you must see the capital discussions page. Right.
No, I see, yes, now I see the capital discussion, the trade images.
Okay. Well, actually, it's just sent a trade update because I kind of expedited an update just now because this market is tricking us again. So maybe before starting the presentation, let me show you what my current Rhino is looking like. I'm about almost like 7.5–8% profit on the May trade. It looks like this. So basically, yeah, I'm going to start the proper presentation, but let's say that the Rhino is one of the many variations on the put butterflies. I now apply it more on the SPX, and I try and keep it as simple as possible with a flat T+0 line at all times. But some of you may not be that familiar, so let me just get going with the proper presentation. I don't want to redo everything, but I guess some of you may be new to it. Some have seen the presentations from Brian Larson. I took over from Brian in June, July last year. I used to be more of a Jeep weirdo trader, and I thought the Rhino would be an easier trade. So I joined the many butterflies. So here's the Rhino trade. This is me, the ugly face on the right. Just to tell you where I come from, I used to be a quant. I've got more of a scientist background. Did a lot of quantitative analysis, financial mathematics, stats, and I specialized in artificial intelligence. And for some reason, about 8 years ago, I decided, well, I'm tired of looking for the Holy Grail. I'm going to go for something a lot simpler. And I thought options. Well, I've traded options since the mid-90s, but on and off. So I went back to options as a very stimulating enterprise, but also as a way to make money without sweating too much. So because I took over from Brian, I want to say that every time you take over and you obviously change things, you make it your own. And I always suggest people who are following me on the alert service or from other media that in the end you have to adapt it to your own expectations and risk profile. I always have that little page because even though I was born in France, I'm very much of an African, and I can't help thinking about the real beast, the real Rhino. So I always put up that page to remember that the ordeal of those beautiful animals in Africa. Okay, so I'm going to go back to the guidelines, and the reason why I asked Tom to organize this roundtable is that for those who have been following me or following the rhinos or either the white rhino or mine, some I think have requested to so that I discuss more about the little variations of the Rhino in the last year, or almost a year. So we'll go back. So this is I'll go back to the basics for those who are new to it. So yeah, the Rhino is a hedged butterfly, hedged put butterfly. The M3 use a deep in the money call. RTTs use other management techniques. There are many ways to manage butterflies. Brian Larson came up with an interesting idea of also hedging Vega with a call calendar on the upside, which I thought would be quite interesting to mitigate the Vega risk. Obviously, some people are either adverse or afraid or unfamiliar with calendars. And I want to say that it's only one of the possibility to hedge the upside, but we'll go back to this in a moment. So this is how. Oops, sorry. I mean, it looks like my presentation is a bit. Anyway.
No, we can see it.
So this is it. Okay. Yeah, but I can see my PowerPoint didn't. Anyway, it's all right. So this is a typical rut rhino, Russell rhino. The wing size is 50-40. We place it the upper long just outside the tent by 10-15 points maximum. That we look at when we set up a rhino is obviously the skew. We want to start like all hedged, similar hedged butterfly techniques. We want to start with a very flat T per 0 line. And for those who have seen presentations from Brian or even my own presentation, I think in July and September, I think in September, October, I also did one on extend the options drive. This skew, it becomes a problem in very, very low IV environments, as we've seen, especially in the last bull run since the elections. So this is a typical one. We start with 5. I mean, as you can see, there's generally a fairly good downside cover. I mean, you are initially assuming the modeling is correct. You have about 5% cover on the downside straight away. So that may not be strong enough for a very sharp move like 10%. That would actually trigger the circuit breakers, but in most markets, that's more than good enough. That being said, we can also look at possible hedges on the downside, call them bearish hedges, or you can have a look at Ron Bertino's STT. There are various ways to give it more solidity on the downside. This is not actually a recent screenshot. As you can see, the rut was much lower at the time. So the rut rhino entry is 5 50-40 put butterflies. I mean, this is just a reminder of how it's set up. If we start already with some variation from Brian, started his rhino. I mean, he started looking at rhinos from 84 DTEs, but in general, he was actually waiting longer to enter more around 56 DTE. It is true that if you enter 56 DTE and you keep it for about a month, you don't have any overlap problem, and then you can really have a capital base which is known, like your planned capital, which for the rhino is $25,000, and you can actually close a position, open a new one, and that's fine. I start earlier, especially in the low IV environments, because if that's coming back to the skew issue, is if you start early, you'll have a flatter T plus 0 line. The the later you enter, the quicker you will have to hedge, because you will have or if you're more experienced, you will know how to maybe compensate the delta Vega balance. But let's say for most people, you want to start with a simple trade, simple setup, and a flattest possible T plus 0. So I would say, if you have the capital, start as early as possible so that the skew is flatter, the T plus 0 line is flatter. As for most of these trades, it's better to you sell volatility. So if you have an IV pop, that's a chance to get a better price. Since September, October, with the Russell being a little bit tricky, I moved to the SPX Rhino. That's something that was already backtested by Brian for some time. I think he also switched from Russell to SPX early last year, and the equivalent of a 50-40 Rut Rhino was to use a 80-60 wing broken wing butterfly. Similarly, you just put the upper longs 10-20 points above the money, so it's the same shape. The only big difference is that SPX has a stronger skew and costs more. So where you can actually enter 5 put butterflies on the Rut, on SPX you can only afford 3. Otherwise, the management is very, very similar. So it makes really no difference. I mean, I haven't actually tested it on NDX, but I suppose it would work just as well. So for the same reason, and maybe even more for the SPX, which has a stronger skew, I try and enter as early as possible. For the Russell, the scale in is actually doubling your entry by adding a tranche of another 5 put butterflies. And if you, for those who have seen the original guidelines, the trigger to add those that second tranche was when the underlying the Rut here, when it leaves the 10 by 10-15 points, and you place the second batch of flies about 20, sometimes 30 points above the initial tranche. What I have done in my new guidelines, I'm not actually bending the rules. It's just that I thought that it would be actually better to use capital more efficiently. I mean, use your $25,000 that you have. So I always scale in. I will not wait for a trigger, and I will scale in sometimes in the same position or sometimes lower, and I try and get to the full position by 56 DTE. So you may have a broader tent, a larger tent on the other side. So for the SPX, you add 2 or 3. So if you use the 80-60 wing put butterfly, you probably will afford another 3. If, like I've been doing in the last 6 months or so, I've actually decided to go a little easier, more conservative. I can only so with a 100/75 wing butterfly, I decided I could not afford an extra 3, so only add 2 to the initial tranche. So it's 3 plus 2 for the 175. It's 3 plus 3 for the 80-60, and as you remember now, for the Rut, it's 5 plus 5. So again, SPX and Rut, same guidelines, same rules, same alerts. It's just that we have to deal with capital. I mean, obviously, money doesn't grow on trees, so we have to deal with our planned capital quite diligently. As a here I want to remind that the initial skew is quite important. That's why we want to start for the rut. I want a delta maximum 10, 15, minus 10, minus 15. With the SPX, I can sometimes accept a little bit more, but obviously, if we had a healthier volatility, that wouldn't be a problem because we would have a flatter T plus 0 from the start. So one way to deal with that is to enter as early as possible, but at the same time, there will be more chances of a lapse because you may have 2 and even sometimes 3 cycles on at the same time. So the mid IV, which when your IV ranking is in the 35, 40, 50%, that's what I call the best playground for the Rhino. If IV is pretty high, you may want to be a little bit more conservative on your setup. But there again, you can keep a similar ratio between your wings. Like if you have a 100/75, it's about 1.2, 1.3. On the Russell, if you had a 50/40, that's a 1.2. Basically, as long as you keep the same ratio, it will be the same type of management. So the typical adjustments on the upside, it's basically reducing the negative delta. The typical upside adjustment is to buy out of the money call calendars. You place them about 20, 30 points above the initial horn or initial butterfly for the Russell, and maybe up to 50 for 50 points for the SPX. Here you see delta limit is at minus 25 for the first tranche or 50 for the full position and inside the tent. I tend to be more conservative outside the tent. So if you are already outside the tent with a delta growing a bit too much, you may want to start adjusting at minus 40 for a full position. And if you remember that you can have, for example, 10 butterflies for the Russell or 5 for SPX using a 100/75 wing butterfly. Basically, you can consider 10 points, 10 delta per fly. So you can, if you're still in your first batch of let's say 3 SPX butterflies and your delta is minus 30, that would be a trigger. We'll have a look at some backtest or earlier positions. Sometimes because I don't feel comfortable with the market, and I will enter not 3+2, but maybe 3+1+1 or 2+2+1. So basically, you adjust your delta limit as per the number of flies you have in the market at that time. A variation that, to be honest, I don't use at all is the call broken wing butterfly on the upside. For those who are a little bit nervous about call calendars, you can look at Randy's version of the white Rhino. There's nothing wrong with the call broken wing butterfly, but to me, it changes the balance because you add more vega, more negative vega to your trade. So even though it looks the same, and obviously it can be more comfortable to trade in a single expiration, it's still a slightly different beast. It's your delta vega compensation may be a little bit different. So as long as you trust your modeling, that can be no problem. But if you have sometimes some concerns, I would not advise to just pick either or. I don't like the calendar, so this time I'm going to use a broken wing butterfly call Burgundy Butterfly on the upside and just manage my position the same. No, it doesn't work that way. You must put yourself in the mind of a different trade. On the downside, if you have your calendars, they will probably have done their job hedging some Vega, and you just take them off. A call calendar is not a good hedge on the downside. I mean, if it's a call calendar, it's basically quite good on the upside and even pretty good when the market is backtracking from highs. But if you have the market going seriously down, they are pretty useless. So they're not meant to be used as a hedge against a fall. So we can discuss other variations, even calendarizing some of the shorts on from your butterflies, or adding a put calendar, but that's another variation. You will see that we tend to hedge quite rapidly, delta limit only plus 25, so you don't wait too much. And as a secondary safe measure, I'm always wary when, regardless of the skew, I'm always a little bit wary when the market goes past my first horn, the shorts of my butterfly. And basically, you want to trade in between the horns. Anything outside is more risky, in my view. Just a reminder of the profit or exit guidelines. So the planned capital is 25 without allowance for overlap. So if you really trade 56 DTE to 28 DTE, regardless of the skew, you will manage your position in and out. You can deal with 25K. I decided, even though it was a bit painful sometimes, I decided to stick to the max capital that Brian set out more than a year ago, which is basically 1.5 position. When you have 3 cycles on, it's tricky, and that's also a good way to learn how to lay up your positions, to start scaling out to scaling in. It's actually a good exercise, but sometimes you also obviously lose in some profit opportunities because you may actually taking capital off a good-looking position. So the profit targets, as per Brian's back tests, have been set to these. I haven't changed that at all. The thing that I have added since December, January, for the more experienced trader, and obviously those who can afford the extra capital, I now split or spin off my regular position, I call it the reg Rhino, to the extended Rhino, and then I take it to expiration week. Obviously, we've had very much of a bull market in the last month, so it was not so much of a gamma game. It was fairly easy, so it was not actually that difficult to trade to expiration for those who could afford it. This is my track record. To be honest, this is no longer true because today my MA position is taking a bit of a knock. But as you can see, this is the average for the full length. So on planned capital, 470%. Using the figures from the extended trade, it's slightly higher. And my year-to-date, obviously it's a bit lower now because the May position, but I'm still way above 20% on my trades year-to-date, which isn't bad. And because I always try and keep at least 20% cash, and also have some other experiments on the side. So my actual return on full account, on my whole account, was as of April 1st, it was 16.3%. Okay, so well, there are maybe questions. I mean, I'm quite happy to take questions anytime because I'm just going to go quickly through this and maybe show some of the trades of the last few months. So I wouldn't say it's a beginner's trade. I mean, it's very important to know your Greeks and know your spreads. Otherwise, I mean, I know that Brian wanted to create a fairly mechanical trade. I'm actually writing a training course at the moment, and the first level will be the I would say the Brian's Rhino, the more mechanical one. But the reason why I actually deviated a little is that I saw the backtest from 2013, 2014, and if I was to repeat the same mistakes, I was not comfortable with that at all. So most of those trades, even though they are hedged on the upside, they don't really handle a bull market very well. So that's why I changed the way I manage them on the upside. So I will show you just now. I saw questions. Do I look at do I have a market view? Yes, I do have a market view. Maybe I should. Yeah. I do have a market view, and I use this as a market view.
Bruno, did we just lose you, audio? I think I heard you ended up leaving.
Okay, I think I had a quick.
Okay, I think you're back now. That's good. I hear you.
Right. Sorry, I think I had a glitch on my internet connection. Okay, I see some questions. Do you look at the charts when you put this on? Yeah. Right. Yes, I do have a fairly simple chart, which is public. I'll give the link to anyone who wants it. So basically, it's on TradingView, so it's a free platform. I basically use the typical Bollinger Bands, Fibonacci levels. I do have a proprietary indicator, but it's a pretty complex from a math perspective, but no point really looking into the details. But that gives you generally a fairly good turning points, particularly when this line is quite low. This long will be strong. Like here, the line was high, the short was pretty strong. So you can see that sometimes the short comes even before the bull run is over, but at least you can actually prepare for it. Another thing that I use, because I don't really use those what we call static support resistance levels, the S1, S2, S3, L1, and R2, R3. I don't use those. I use something called Merry Math lines, which is more dynamically calculated. It's based on Gantt for those who want to look into it. So this why I mean you can see here that 2375 was a pretty strong resistance. It doesn't mean that it can't be penetrated, like it's been on 2 occasions, but that's pretty strong, and I can probably see the market battling again, even though we also have some graphical pattern here, which also exacerbates the likelihood of a breakout either way. So I can definitely see some fighting here on this level. Right. So this is what I look for. So obviously, if we have a down day or down signal, I can expect. Obviously, this is only price. I'm not looking at volatility or fixed here. But assuming that volatility will also go up, yes, I will definitely look at it as a good entry point. And conversely, an exit point if vol is to abate or on the reversal up. But I mean, anybody can use a simpler oscillator and probably get a similar result. I'm just used to my own algorithms. So this, just to explain, this algorithm is supported by a histogram, which is basically the correlation with the price. So if the signal here is down and the histogram is very high, it means that there's no divergence between the indicator and the price movement. So and here you have signals, but with a much lower correlation. So it's not only the indicator itself is closer to zero, so it's less powerful. But if you have divergence, you must take it with a pinch of salt. But and you must also read signals in relation to the previous signals. So sometimes this is just a new bout of selling on an original sell signal that was here. So it's kind of a repeat. So here we're definitely on the up, but you can see that the energy is not actually gaining much strength, much momentum. So that's why we have some fighting here. So, but anyone can have its own market view. That's the one I use. And for those who are on my alert service, I do every day a 3-4 line commentary on the markets and the way I see it. Right. So let's go back quickly on. Oops, no, that's what PowerPoint. Right. Well, actually, the next slide was about the market view. Yeah. Right. Another maybe difference from Brian Larson is that I trade. I mean, I'm in front of my screens actually even more than twice a day. You can, if you trade the mechanical way, sticking to strict delta alerts, basically the Brian Larson's way, you can trade. You can actually look at the market once a day. I still recommend to have at least 2 visits to the charts. Don't trade too much. I mean, twice a day is good enough. But if, like me, you want to fine-tune your order management and get better prices, then you must spend more time, of course. Right. Yeah, that's what. Okay, this is actually an important slide. And then from then we're going to have a look at some previous trades. So when the market was really running away, I had to choose between using call calendars and using simpler methods, like just rolling the shorts up. It's basically a PCS roll. A PCS roll, or basically that's a short condor. Sometimes just doing a reverse Harvey. Well, I'm not saying that I'm actually following the reverse Harvey guidelines to the letter, but generally you will use reverse Harvey to preserve profits. So if your position is making good money and you want to preserve your profits on the upside, you will just pull your upper longs a little. If your position is still in growth stage, you will probably just roll the PCSs with due consideration that obviously those hedges are not interchangeable. It's either or. If you do a PCS roll, you will flatten your delta, but you will add more negative vega to your trade. Because of my market view, and because IV was low, and in my view was meant to was to remain low for a while, I decided to go for PCS rolls in a very conservative way. I keep my delta negative, but and the other possibility would have been to put on a cold calendar hedge, and as Brian did in the past, the possibility is that you will go past the horn, which I don't like, and you start rolling your hedges, and I don't like that either. That's maybe a preconception of mine, but and I know many traders think differently, but in my view, a hedge is a hedge. If you start trading the hedge, then just trade another strategy, and it's fine. I mean, you can trade cold calendars on the market going up and put calendars on the market falling, and if you have the right management technique, you will make money. But to me, it's not exactly the way I want to trade the Rhino. I'd rather push my expiration line and then maybe add a cold calendar, a few cold calendars. But especially if I think that the market is about to peak, and then I think a Vega hedge would be of assistance, or would be a safe thing to do. But otherwise, I don't roll calendars. I don't roll those cold calendars. That being said, because a calendar is Vega positive, and I know some argue it's not as Vega positive as it is. There's a weighted Vega issue. Okay, that's another topic. But in the last 6 months, it was actually a tough call, because you could roll your cold calendars, because IV was so low that you would not lose that much in rolling your calendars. You would probably even make some money on theta. You could play on maybe on the delta of your hedges and maybe save the day, make a bit of money on the hedges. But again, because it's my way of trading the Rhino and the butterflies in general, I don't make money out of the hedges. So that's why I decided to rather go for a mutation into a RTT by just pushing the expiration line up. But I know I'm talking too much. It would be better to show some examples. So here on the downside, you can wait for your plus 25 delta alert to start rolling some shorts down. That's definitely a good thing to do. And as I said earlier, I don't like seeing the market going past my horn, regardless of skew. Maybe the skew will give me extra breathing space on the downside, and perfect. I mean, if the skew can be on your side, good, even better. But I definitely don't like that. If I have 10 shorts and I even move one down, one 10-point strike on the ruts, or 25-point strike on SPX, at least I have. It's like a mental thing. I still have at least one short below the market. That's the way I trade. Okay. What else? Well, that's I've talked about already. And I mean, if you want to trade it differently, you can. I mean, that's really I'm quite sticky about that. I don't like markets going past my horns. Right. Okay. Let's have a quick look at option view. So as I said earlier, this is my current position that has lost a bit of money. So I did a quick adjustment just before this session. It's not quite 8% profit, but it's all right. As you can see, we are 44 days to expiration, 44 DTE now, and I would say I'm already in early descent phase. That's why I've started scaling out already. I should be 5 broken wing butterflies. I've started actually taking money out of this trade. Not that I actually needed much for June, but I thought there's no point keeping this trade this busy. So every time I scale out, I try and keep, I do it in such a way that I flatten my delta. So that it will save me from doing another adjustment. When I scale in, it's a one way of adjusting delta. When I scale out, it's also a way of adjusting delta. So for example, in this scale in, I reduce delta to minus 18. Again, if I use my rule of 10 delta per fly, I've got 3 in the market. So I would say 30 is my delta alert if I wanted to add back some money, some capital into the trade and add a hedge. I mean, it's always possible to think if I want to go even, let's say I suspect there could be a strong reversal. I may just add a calendar here, call calendar here. So I would definitely look at the IV differential, 0.8%. It's all right. And as you can see, I would definitely flatten my delta. I would keep my theta intact, and then I would have a very good Vega cover. And if you look at this, that's a pretty good looking trade. So that's the discussion I've had with myself and some of my subscribers, is that are we in landing phase or are we going to keep it longer? I think now that we've lost a bit, my profit line peaked at 9% or 22.50, and now it's actually retreating a bit too much. So I may just park off my trade with an extra hedge, so that I can really leave it alone for a while. So it's a matter of aborting descent, aborting landing, and say, well, okay, I'm going to travel on this trade a bit longer. So this is something that could be done. I started also the June trade on Monday. On last Friday, most of you have seen that we had quite a bit of window dressing on end quarter with Vega, I mean IV going up in a otherwise flat market. So I was expecting the market to move sharply after that. And oh well, I'm losing a little bit on my June trade. That's okay. But let me show you. I mean, this can look like a weird trade, but it isn't. I have decided to enter 3 broken wing butterflies as per the rules, but for those who trade larger amounts or just don't want to be bothered with fills and executions, all of you know that the 20.5 strikes are more liquid. So instead of sticking to the rule and go for a upper long slightly outside the tent, I kind of averaged out. So I decided, okay, I'm going to put 2 butterflies, 2375, 2300, 2200. So it's a 100/75 wing put butterfly, and I put just one strike above, and that's what it looks like. Also, I choose to sometimes then compensate for the skew. So if I go back, if I had actually done exactly those 2 butterflies, I would have 1, 2, 1 and 2, 4, 2, and you can see it's 3, 3. So basically, at the time of entry, I also added a PCS. I mean, I just had a 1 put credit spread here. So the reason is that I'm not happy with the initial 2, and we're still at very low IV, as you can see. When you enter a trade, I mean, it's psychological, but you don't want to have to adjust right away. You want to let it live and grow. And so because I have a -10 delta per fly alert on before I scale in, I don't want to be too strong on delta from day one. So by adding a PCS here, I flatten my delta a little. My vega is still fine. Now, of course, because I'm not using the original guidelines, that will mean wait for delta to go up and then use the call calendar, or wait for the market to shoot up to scale in. I will scale in. I don't know when, but we are 72 DTEs in next 2 weeks. I definitely scale in, and I will also use the positioning of my additional 2 butterflies to again adjust delta. So it's no rocket science. I mean, it just makes sense to use each and every event in the management of your trade, whether it's an adjustment or scaling, to make your life easier. So this is let's go back to maybe the back trader and have a look at let's have a look at April. Because I decided to take it easy, and I thought May would be easier than it is. I closed it. I closed it on the 3rd. So let's have a look somewhere a week before. Where is it? That's interesting. Is it the right trade? June 17th, sorry, April 17th. Yeah, there you go. So this this was, I mean, close. I mean, this was a difficult trade in a way that it went all the way up and then started retracing a little. So this trade required some management, but then SPX kind of parked off in this area for a while and allowed the price, the position to grow. So it was actually a fairly easy trade, on which I did apply a few PCS rolls, so short condors. So I agree that to some extent I weakened my hedge on the downside, but since we had such of a bull market, you have to compromise. But by keeping at that point, it was actually a bit of a risky position because too flat a delta for strong vega. But I suppose I did that with due consideration. I can't remember exactly what I was, and also that was after the market. So if I go a day later, you see, when you have a market view that the market will going to go up, you would rather want to be prepared on the upside. So this is how the market looks. Delta was then a bit too positive. So, but I've actually prepared to look at. We're not like back testing together now, but this was actually, yeah, we were close to. Oh yeah, that's right. Sorry. We are 24 DTE. If you remember the exit rules, at 21 DTE, the profit target is about 6%. So I was basically trying to give some room to the trade to get a little bit more profit, but I was already again in descent phase. The market, when SPX is actually in this position in between the upper longs and the shorts, and at this point you have a delta vega balance which is fairly safe. I mean, then you just want to flatten your delta, and in that position, I will use my scale out. So my taking capital off the table kind of adjustments to then flatten delta by keeping setup as healthy as possible. So that's what I did, and I think following day, markets position was up again. Well, anyway, I mean, I don't know exactly when I think I closed on that day. Yeah, you see, I started scaling out. I was close to my profit target because the profit target is 1500. So this is how the so I try and keep delta as fat as possible. Um, and if the market was shooting, I would do what I did on previous month, which would be to, because we're already quite in profits, and if you want to then keep the market position longer to 14 or even 7 DTE. In this case, I would have RH'd the last long put here to make it last longer. But on this particular occasion, I decided not to extend this trade. So I had an extended trade for January, February, March, but for April, I was happy to make about 6%. So, and I think by 12:30 I was done. Yeah, and I think I did, yeah, close to my 6%. Yeah. Right. The February trade was actually a lot easier. So, sorry, let's go to March. March was actually difficult. March was difficult. March actually, on the regular trade, I lost a bit of money. On the extended trade, I made a bit of money. So let's go towards the end. Let's say early March. So yeah, I was losing a bit of money on this trade. As you can see, the market was just going crazy. So what I did here is just, you want just to contain the loss. And I knew that at that point I would lose a maximum of half of a percent on this trade. So this is what I wanted to say earlier, that when you don't want to roll your calendars and keep chasing the market, you then do some PCS rolls, some reverse Harvey if you have a bit of profit, and then you make your life a lot easier. I mean, you won't make money every month. This was actually my first loss. So okay, it's terrible, but it was my first loss in a year. But by keeping it small, I was, and it, you can. It's not a loss you don't sleep over. I mean, it's fine. It's and another thing, because we were in a very low IV environment, as you realize that this trade was 16 DT, so it was meant to be closed anytime. And I had April on, and I had started May. So that's the thing I was talking about earlier, is that sometimes, even though you would like to fight for that trade and break even, is it more worthwhile putting money on a winning trade the following month? And that's what I did. And April, as I just showed you, I closed for 6%, and yeah, and May is now about 8%. So, and for those who could afford, because they're like me on the portfolio margin, I had an extended, in which I allow up to 25K, no matter what. So basically, the extended trade will always use max 25K Reg T, regardless of overlaps. So this trade was also not doing too well, but because I had more time, I didn't have to worry about capital being transferred to the next position. I managed to actually, I had yeah. So I reduced the loss. I always keep it below 25K, and I managed to end up making a bit of money. So I'm just gonna close. I go to, oops, March extended trade log. I close on the 14th. Oh, actually, I let it die. Yeah. and on the very last day, yeah, this is so the very last day, as you can see, or I mean, close to expiration, we're like 3-4 days. 2SD is still in a profit. When it's very, very seldom, but obviously for the extended trade, for more experienced and maybe a little bit more aggressive traders, I take more chances to accept to have only PCS on and with no hedge on the downside. But to me, it was more than safe enough, since we had 2SD at 23.30, so the shorts were much lower. So and I think I closed, and I made like a 1.5%, yeah, 1.5%. Right. So let me go back to the questions.
I can read them to you if it's easier for you.
No, it's okay.
If you don't have multiple screens.
Now I'm actually traveling, so I'm on my laptop. Yeah. How do you decide what call calendar to put on? As I said, you play for the ruts about 20, 30 points above the money. For 25 to 50, or I mean, as I just showed you for the June trade, sometimes you instead of, if you don't find the strike that you like, maybe you will have you'll have one call calendar 25 points up and another one call calendar 55 points up to average out of it. So that's more or less. But really, it's also something quite visual. I mean, if you have your first the Greeks. I mean, your Greeks must make sense. You want to reduce your delta by maybe a third to a half and reduce your vega. If your call calendars are too close to the market, your trade will not look good. As I just showed you as a potential adjustment now for my May trade, in case I abort descent and keep it longer, since we are 44 DT, so I have plenty of time. I can actually go back to that trade, and then let's go to the May trade. The first thing I checked was the IV differential. I mean, that's something of maybe of a higher level. As you can see now, it's actually looking better. I mean, I like it. I mean, ideally you want to sell a lot of volatility in the front leg, on the front leg, but and the narrower is the differential on IV, the better it is. But of course, I mean, with experience, you also look at your put skew. If you do, well, that's another issue. Then I'm going to discuss that in the course. Is that it's not only the position; it's also when it's happening in your trade. If you start hedging late in your position, your put skew will start playing funny for ITM in the money puts. So, and then you will have a even weirder skew across the two expiries. So that's okay. I don't want to confuse you. So let's say that if you do that fairly, I mean, I would say at cruising altitude. I mean, you've your trade is on. You've scaled into full position. You obviously you have already hedged your delta by adding the butterflies at the right positions. And let's say you still have to hedge with the call calendar. If it's somewhere 56 to 28 DT or 21 DT, there's a high likelihood that your call calendars will behave. You will not have this skew on calendars can be quite tricky towards the end. So, and that's why that there was that recommendation from Brian that if you are late in the trade, you may want to go for a call broken wing butterfly because some, I mean, everything is possible, everything is manageable. But for those who are not familiar with calendars, you it can trick you, it can surprise you. Okay, right. Any other question? Have you tried this further than 70G and beyond? No, I haven't because I took as a challenge, and I sometimes find it quite difficult to stick to the $37,500 planned capital for all my cycles on at any one time. So for that reason, no, I find it difficult enough, particularly in a low IV environment where profits take much longer to come to your trade. So, but if you're on PM and if you want peace of mind, sure. I mean, try. You can start 84 anytime. The earlier the better. The earlier the easier. Also, I see that we are now past 1 hour. So if there are any other questions. Have I lost anyone?
No, nope, you haven't. You still have practically everybody who signed on from the beginning is still on. No, I think that's all of the questions. Bruno, a couple of things just in closing. What's happened over the last couple of years, obviously, is that the difference of the implied volatility, you called it difference or put skew, I don't care what you want to call it, but those puts far below the money versus at the money versus in the money, not only have they changed over the last couple of years, but they also move much more rapidly.
Yeah.
What are you finding? Okay, are you looking at that out at 7 days or whenever you put these things on, and are you setting up your trades differently based on the different environments?
I would say that I was quite confident about my market view for a start. Otherwise, if I had the slightest doubt, I would definitely go easy on my Vega exposure. Because when IV is so low, of course, IV spikes are more radical.
Very much so.
Yeah.
And they don't spike evenly on all of your strikes either. That's the other problem.
That's very true. And sometimes I have trouble with some adjustments because I can see because of IV or like yesterday I missed an adjustment. Maybe I was too stingy, but my upper long put was undervalued. The IV there. I know we're not skewing up yet. The smirk or smile or whatever. It's a bit maybe too early in the trade for May, but there was no reason for it to be that undervalued unless some people had obviously some insight that the market would shoot up today. Possible, but there was no reason for. So yes, there are some anomalies, but you've got to live with them. Yeah. And,
it is a challenge.
Yeah.
Yeah. But, I don't know if you've looked at. I'm sorry. Go ahead.
No, I'm just saying that my market reading. I mean, this is a lot of personal thinking, and I mean, and of course, I'd like more discussion, exchange, and I'm not saying that I'm always right. Just maybe I'm very fortunate to have been more right than wrong in the last year, and I would say that having 20-odd% profits year to date using this kind of strategy is pretty good. But did I take a chance with my Vega? Or it's I've also seen that as you correctly say, the modeling has been perfectly with a T+0 line that looked perfectly fine with all the compensation. I mean, you assume that OV does a good job at projecting what the market, what your position will look like if the market drops, whatever. And I know that Black and Scholl is not very good with sudden spikes. It needs a more continuous move. So spikes are hardly ever modeled properly. But we haven't had spikes, and yet we had some strange anomalies in modeling lately. So you've got to mentally compensate for those. Yeah.
Yeah, it's the market's very different today. The algo traders and the high frequency guys have reached our markets. Okay, and what they end up doing is that when the markets have these push higher, the way they've had, okay, since the U.S. elections, where IV's been very low, what ends up happening is that the puts below the money get to be relatively more expensive than the puts closer to the money. Okay, for geeks like you and I, we would say that the put skew got steeper. Okay, but that ends up changing, okay, your pricing. That also can end up changing pretty dramatically your risk, because what's happening is that if you go and you try to model on, and I don't care what you use, you can use Thinkorswim, you can use OV, you can use any tool you want. What they don't do, what none of these tools end up doing, is allowing you to end up changing what that put skew looks like. Because what ends up happening is that those puts below the money don't end up raising, they don't end up increasing at the same percentage as the puts at the money. So what happens is it really changes the dynamic of your whole butterfly, because you have such wide strikes. The wider your strikes, the more you have to end up taking a look at that. What I've done, or what I'm always more concerned about, is, and what I've liked what you've done, is that your real risk is on the left side or the downside of your butterfly. If you have risk because you keep running up, and people sometimes get concerned, oh, there's a small loss, I have a 2% or 3, whatever you might be running, it's a very manageable, defined risk to the right of your butterfly. Yeah. And that becomes really, really important. Okay, one of the things that I've done, I don't know, have you looked at Volvantage at all?
No.
Okay, because what I've done is that I've taken a look and I said, I don't want to end up increasing my risk to the left side of my butterflies. Mm-hmm. However, I still need to make money, okay, in this market that runs up and runs up and runs up. And so Volvantage tends to end up doing extremely well when butterflies, okay, traded below the money, whether you're using the long call or not. It tends to do very well when the market is in these grinding up markets. So we've been giving it free to everybody at Capital Discussions for a few months now. Right now it's in cash, and this is where I was going with this. It's in cash because the implied volatility of the futures, and I have about 5 different proprietary indicators that I've built off of using things like different term structures and the VIX and put skew and other things. Right now, the puts, okay, skew is quite concerning. We actually went, again, another geek term, we actually went into contango in the first 2 months for an hour 2 days ago. And so the market's very, very jittery. I think that when we do get a sell-off, it will end up being quick, but not necessarily a long duration. And these are the exact types of challenges that traders like us end up having, that if it runs through your positions, people end up adjusting. And I saw in one of your slides, it was so true, you have to be very careful that you don't get whipsawed. Okay. Yeah. And so by keeping your T+0 line, and you did a lot of things in here by keeping your T+0 line and your risk well managed, I thought were a very good idea in and around. I will end up telling you that and you mentioned some things about hedging to the downside. There's, I used to end up joking, and it's really not a joke. I don't know if you remember those old German commercials about Porsches. Porsches, there are no substitutes. So I used to end up saying, Porsches and puts, there are no substitute. When the market runs down, the problem is that if you're trying to buy those teenies or those small puts below the money, they're outrageously expensive because their implied volatility is so high. Mm-hmm. So how do you end up structuring it? And that's, I think what you ended up doing, I know I ended up doing this, is making sure that you're very conservative to the downside with your butterfly structures. And, I always feel that if the market is kept to the right side of a butterfly like yours, you can manage just about anything. It's when you have a very steep put skew and it starts to go into your butterfly and IV goes up and put skew gets flat. I mean, there are all of these things that make that T plus zero line that you mentioned on option view or anything else makes that T plus zero line not be accurate. It's less accurate today when you're looking at that T plus zero line than it was 5 years ago or 4 years ago. And
Yeah.
so you're back testing when you take a look at what ends up happening. It's because that rate of change of the implied volatility at different strikes happens much quicker today because of all the high frequency and algorithmic trading that goes on with the futures and with the, not just the futures, but also the options. And they actually the algo guys will end up using futures on the VIX, futures on the S&P 500, options on the VIX, options on the S&P 500, and they play against one another, and hence the algos make things move much, much faster. But this is almost like a game, like I don't know if you remember that carnival game, Whack-A-Mole, where you had the hammer and you had to hit the moles down, and every time you hit one down, one would come up.
Yeah.
What ends up happening, if they end up changing the skew, they may take away some opportunity in one place, but that almost means by definition that other opportunities will end up popping up in other places. And what I tried to do with VolVantage was saying, hey, when we're struggling with our trades, this is a very nice complementary trade. And so one of the things that, and I don't know if any of your subscribers know this, but if you subscribe to any of these services from Capital Discussions, you also get a 25% discount off of the VolVantage once we start it. And so I was just doing that as a way for people to end up seeing. And when you line up what your back test looks like to what your hedge or your service ends up looking like on how you're going to end up handling your difficult parts, it looks rather attractive.
Okay.
So.
I have to say that I'm not a very orthodox trader in the way that I have very, very little trust in backtesting.
So do I.
It's good for learning, but it's good to boost your self-confidence, but it will never happen that way, even if you have the exact same configuration. I mean, the market will still find a way to trick you.
When I was licensed and I was a money manager, the SEC never lets you make a guarantee that the sun is going to rise tomorrow. And I used to end up joking. I say, the one guarantee that I will make you is that the exact same scenario in your back test will never happen again exactly the same way. The implied volatilities will be different. The skew might be a little bit different, one strike versus another. Everything's going to be a little bit different. It gives you more experience without question, but you can't end up basing things on backtest. The other thing is that, and you even heard this from some services, the problem is that they curve fit. The simple way is, if the way equity, trade service used to work and say, well, you know what? I'm not going to use the 50-day moving average because the thing is it crossed over here. If I use the 57-day moving average, look, we didn't end up coming here. Well, that worked that one time. It doesn't mean that it's going to work in the future.
Yeah, I think I'm going to build another module and I'll have another roundtable on my view on hedging. At the moment, I've played around with bearish hedges, vaguely inspired by Ron Bertino's STT.
And what is that?
Well, I didn't manage to make any money, but it's probably me.
No, it's not you, because the thing is, I've seen people try to do these super wide butterflies, broken wing butterflies below the money, and what they don't end up accounting for is that they don't end up accounting for the way that skews will end up actually changing. I ended up working with several PhD quants on what skew curves look like in terms of the put skew and how they end up changing. And the problem with any type of long back spread, or if you turn it around and do it the other way and do a broken wing butterfly far below the money, the T plus zero line on your graphs looks absolutely great. And in your back test, when you end up going and doing these things, everything looks so smooth. The problem is that if you ever try to end up doing this in a real environment, put skews change so much that those far below the money broken wing butterflies don't end up trading the same way you think that they will, because what ends up happening is that IVs, and here's your problem with your back test. What do I back test? When IVs go up to 25 or when they go up to 80? Okay. What do I end up doing? Do I end up doing it when the put skews are at a 3 standard deviation level of steepness, or when they're at a 3 standard deviation of flatness? Those are all the things when you end up doing a back test are absolutely useless. I went to end up presenting one time to the J.P. Morgan head of all of their quants, and his first question to me was, what does your volatility skew model look like? And if you didn't end up answering that question, the meeting was over.
Okay.
Okay, so it is a little bit more complicated than just throwing on a single trade to work in all environments.
I think it's worth having another roundtable on skew and hedging, but maybe we'll call it today. I mean, just want to answer that last question. Do you look at an ideal broken wing butterfly price for 770T? Well, on SPX at the moment, with IV where it is, I would say $10 is acceptable. If you can get closer to 9, that's better. Yeah. That would be my answer.
Questions, everyone? Yeah. I'm just looking. I think you've answered all the questions. Any other questions that anybody has? I think that's it then.
Thank you, guys. Thank you, Jim. And
Bruno, thank you for the time and effort you've put in this and sharing it with the community. We all appreciate it.
Thank you. Okay. Bye for now.
Bye now.